Hello, Steve Lentz here with the Prepared Mind. This is the market likelihood report for Friday ending April 22nd. It's Sunday the 24th, getting ready for Monday, April 25th, 2016. You can go to the Discover Options website, click on the blog link, and that'll take you to the text version of the Prepared Mind blog entry. That's done by Frank Fahey every weekend. In there, you'll find a nice chart that he's done with double calendar candidates coming from earnings. He's done a lot of work on earnings. He teaches our mentoring course for earnings. Those of you that like to trade off earnings and trade options, there's some wonderful spread and calendar opportunities there, and Frank gets into that in a great deal of depth, so check that out. Friday, we ended with this technical scenario here. We had a high was lower than the previous high. The low is lower than the previous low. The average true range was definitely under, say the fourth decile or so, underneath 1.5. We're above the 40-day simple moving average. I'm adding a little bit into the stochastic where we're definitely in the overbought region over 70, yet we're underneath our 3-day moving average on the 15.3 stochastic. So it's coming off that, coming down a little bit. Okay, so that's the technical scenario. Now, what we like to do with the likelihood report is that we ask ourselves this question. Since January of 2000, how often has this same scenario occurred, and what did the market do? So we have this specific setup here. Lower highs and lows, stochastic coming off of overbought, a pretty tight ATR, okay? And we're trending upward. So when we look at that over the last several, years going back to 2000, what we're going to do is come up with a likelihood report where we first understand the historical distribution of price. Okay, then we're going to look at the distribution of price after this particular setup. Okay, if the two are different, then we know that we have a possible trading edge. We call this edge analysis, and this is going to give us a clue as to where the market might go in the next 1 to 3 weeks. Let's first look at the historical distribution of price. What we like to do is use volatility bands. Now, those of you that have been through this, you could skip through to the end. I'm going to walk you through real quick how we do this. We set up volatility bands in 3 different time frames, 5, 10, and 15 days out. We look at the last 20 days of volatility. We take a 20-day statistical volatility measurement and apply it to create those bands. These are log normally distributed, and they're set 1 standard deviation from the close. So here's an example. You have the close, you have the band that's above it, the band that's underneath it, and what we ask ourselves is this question. In the next 10 days, these are 10-day bands, in the next 10 days or 2 weeks, will price go up and hit the upper band, go down and hit the lower band, or wobble around and stay in the middle? Okay, so let's see what happened in this particular case. In this case, it went up and hit that upper band, actually in the very next day. So now we have another situation. Here's the close here. Oh, timeout. Okay. Will price hit this upper band in the next 2 weeks, the lower band in the next 2 weeks, or will it wobble around and stay in the middle? All right, let's go and see what happened. It came down to try to get that lower band if you look right there. Okay, but it didn't quite make it. Didn't quite make it. So where does that leave us? Okay, that says we post there that it hit neither. So what we like to do then is record from every close how often price struck the upper, the lower 5, 10, and 15-day bands. Okay, and that will establish our historical distribution of price. And this is kind of what it looks like right here. And I'm just going to grab this. There you go. So it hit the upper band, and this is measuring, oh gosh, sorry about that. I should have put here, this is actually going to the 22nd. Copy and paste is the bane of our culture, I'll tell you that. Look at that. So it hit the upper band over the last 4,082 closes, going back to January of 2000 or so. It hit the upper band almost 30% of the time. The upper 10-day band, 23%. The upper 15-day band, about 23%. It went down and hit the lower 5-day band, about 30%. the lower 10-day band about 30%, and the lower 15-day band 32%. So this establishes our historical distribution. Okay, now we're going to go and take a look at the distribution after that technical scenario developed. Okay, so if we take that scenario, we could go back in time and look at all the times that it happened. And what I like to do is not only look at each time as of the close, but we like to look at the distribution and do those measurements as of the close. Also, if the distribution, if price went above the high, in this case of Friday, or if it went below Friday's low. What's the distribution? And I think you'll find that it sometimes can be dramatically different. Okay, so before we get into those statistics and come up with our likelihood report, just want to remind you, you could go to our website, check out some of the packages we have. We are a mentoring company. We specialize in the one-on-one mentoring experience, but we also offer for $495 a year access to a lot of the wonderful information we have. I do an Inside Wire webinar every Tuesday morning at 11, and if you sign up for our continuing education, or just to put your toe in the water of some high-end options education, you'll get 300 to 400, it's in the 300s anyway, Inside Wire archives with research just like along the lines of what you're seeing here today. In addition, you receive a wonderful stock analysis report and a whole bunch of other, and some live trading sessions that have been archived as you watch our mentors as they actually trade. It's awesome. So check that out. We'd love to have you as a client, and perhaps even for our mentoring programs as well. And there's several packages you'll find at the website. Okay, also let's see here. Oh, here's the Inside Wire archives. You can see some of the titles down there. One thing we do every month is we go over the core strategy review of all of our non-directional trading strategies that we teach in the Equities Track mentoring program. There's a phone number to call. We'd love to hear from you. Market likelihood report. Here we go. Let's take a look. All right. So with this particular setup, as of the close, you'll see that over the course of 189 signals, okay, about 22% of the time it hits the 5-day upper band versus about 29.5. So it actually hits the upper band 7% less often. The upper 10-day band is about a scratch. The upper 15-day band, 1.4 additional. So that's a scratch. What's interesting here is that it doesn't hit the lower band as much, by a little bit on the 5, not that much to write home about, but on the more distant 10 and 15, it just has trouble getting down there and hitting those roughly 25% of the time. Now, what if price went up and exceeded Friday's high? What's the historical distribution if that happens? And here we have 121 times it did that. Okay, if it goes up above Friday's high, of all the times that it's done that, it's only hit the upper 5-day band 18% of the time, upper 10-day 17%, the 15, 20%. And so across all the entire spectrum, it hits the bands at a lower rate. So what this is telling us is if it goes above Friday's high, it's going to hit all 6 bands on average. It has hit those less often in the past. So we have a likelihood that volatility will be less than what it historically has been. So that would favor the credit spread seller, the condor seller, the butterfly trader in terms of timing if it goes above Friday's high. Let's look what happens if it goes below Friday's low. Here it's kind of a scratch. 3 of the bands, it actually it's hit those more often. Okay, you can tell it actually will get more volatile. It actually hits the upper 10 and 15-day bands more often if it goes below the low. So we're seeing here more volatility is what that's telling us. Okay, it's to the upside if it goes down below Friday's low. Very interesting. Now, I want to get to the notion of implied volatility. Here, let me, just a second. There we go. And we're going to talk about implied volatility just a little bit. You can see that implied volatility generally is higher. And what we're going to do is use implied volatility to recast our historical bands. Okay, now if we do that, we call these the skew adjusted VIX, because what I like to do is apply a different implied volatility level to the upper bands versus the lower bands. Okay, VIX is generally higher, and so but the calls have a lower implied volatility than the puts. So the upper bands, to be a skew adjusted VIX bands, the upside needs to be closer to the close than the downside. So we have created these skew adjusted VIX bands that are wider apart because the VIX is generally higher than statistical volatility, and so those bands are going to get hit less often historically, and you can see these numbers are a little bit lower, but they're more balanced in terms of what the market expects because these upper bands are closer into the close than the lower bands. Okay, now let's look at the numbers again. Here, when we use VIX or skew adjusted VIX at the close across all 6, you have less volatility. Okay, favoring the premium seller. Here we have on Monday, if the high were to be exceeded, look at these numbers, quite dramatic. 7, 6, 7. I mean, these bands are only getting hit between, well, now this one gets hit quite a bit way out there. But 5 of the 6 are hit less than 10% of the time. And if it goes below the low, okay, again, all 6 are covered, with now this being, between 8 and 15% or so. All right, so if you were to use a VIX adjusted 1 standard deviation condor, what would that look like? Here we go. On the call side, if you went up above, notice down at the bottom, the upside volatility is at 11.7. Okay, what happened here? Just a second. The downside volatility is at 14.8. I'm getting this goofy thing come up. There we go. Boom. There we go. And 14.8. There we go. All right, so here's the call side. If we went out to do a 2-week condor at the 2140s, on the downside, using the higher volatility, that puts us down to the 2030 puts using Friday's close. And when you analyze it, this is what you have. Notice that if we're out here and this is only getting hit something like 6% or about 10% of the time, this is getting hit roughly 6% of the time. You can see that if 8.5 times we get our 15%, then those other 1.5 times that it hits this side or that side, you can see we're going to have a clear statistical edge anyway, as of this particular setup that we have in the market. So I hope that information is helpful to you as an options trader. Again, if you're interested in our other products, please give us a call. You can go to our website. We'd love to hear from you. And I hope you have a great week trading. Take care. Have a great week. Take care. Bye-bye.